One of our international members contacted us. They reached out and they want to know more information about the periodic inventory system and the impact that has on the chart of accounts. So what does the chart of accounts look like when you have a periodic inventory system? So under the periodic inventory system, detailed records of inventory movements are not maintained. There is no continuous record of how much inventory on hand we have at a point in time. Now, the only way to determine the inventory we have on hand is to do a stock take or count the inventory in the warehouse. So under the periodic inventory system, the inventory account is not debited or credited every time an item of inventory is bought and sold. Therefore, the amount of inventory shown in the balance sheet during the year is not the current value of inventory on hand. So we have our periodic inventory system. What does the chart of accounts look like? We have 5 accounts that we need to have. We have opening inventory, purchases, an account called purchases, returns and allowances, and closing inventory. Now they're all in the profit and loss. We'll also have an account called inventory in the balance sheet, and we'll show an example of this in a minute. Now in our example, just like our perpetual inventory video, we have opening inventory of 100 items at $6 each. We're going to buy another 50 units at $6. So the journal, purchases debit for $300 and cash credit for $300, presuming that we're paying for the goods or the inventory in cash. Now let's sell 20 units at $12. The journal entry, cash debit, sales credit. How did I get the $240? Well, it's 20 units multiplied by $12 a unit, and hopefully you can see that. And we're presuming here that we've sold the goods for cash. So this is under the periodic inventory system. This is our journal, and you might compare that to our previous video where we only have one journal here. Now let's say it's the end of year. We need to count the inventory in this example. So remember, with the perpetual system, there was no journal entry for year end. We kept a record of the inventory after each transaction, and we knew the balance and the value by looking at the balance sheet. This is now changed. Let's count our inventory, and we'll presume that we have 130 units on hand. How did we get that? Well, we have our opening balance of 100 units. We've purchased 50 units, then sold 20 units of inventory. Now we need to do 2 journals here. The first journal entry transfers the value of opening inventory from the balance sheet to the profit and loss. The journal is there. Inventory, opening, debit, inventory, balance sheet, account, credit, $600. The purpose of the journal entry is to transfer the value of opening inventory from the balance sheet to the cost of goods sold calculation section in the profit and loss. The second journal will record the following in terms of the closing inventory. Remember, we had 130 items on hand and they were $6 each, so that's $780. We're going to debit inventory in the balance sheet, $780, and credit closing inventory, which is an account in the profit and loss, for $780. Now the purpose of this journal entry is to record the value of closing inventory in the balance sheet as well as the cost of goods sold section in the profit and loss statement. So finally, here we have an extract of our profit and loss. The sales revenue is $240. We have our opening inventory of $600. We add the purchases to get cost of goods available for sale. And then we have the closing inventory of $780. We take the $780 away from the $900 and we get cost of goods sold of $120. That is the cost of the sales, which means that's how much $240 worth of revenue has cost us in inventory. Our gross profit, $120. So that is a very brief introduction into the periodic inventory system. And you may have further questions. What about purchases returns? How do we account for the GST? Well, join us on our website, bluestartraining.com.au. Membership is free. And don't forget the Australian Master Bookkeepers Guide. We have a dedicated inventory chapter in the book.